Every choice builds a future. One path spends the moment, the other grows it.
Welcome back to the Deep Dive. Today we're taking a sledgehammer to one of the most persistent myths in modern finance.
Which one is that?
The idea that, the only way to get truly wealthy is to ditch your reliable job, launch some high-risk startup, or, I don't know, get lucky with crypto.
The hustle culture gospel.
Exactly. But you brought us some material that challenges all of that. It's a strategic blueprint, really, from excerpts of Salary to Seven Figures. And it's so refreshing because it just cuts through all that noise.
It does.
So our mission for this deep dive is, well, it's simple, but it's also pretty profound. Can a regular, steady 9-to-5 job truly be the only thing you need, the exclusive launch pad to become a millionaire? And if it can, what's the actual playbook?
And that is exactly the premise we need to tackle today. The analysis, it makes a very compelling case that, yes, it is absolutely achievable for ordinary people.
Not just for the outliers.
Not at all. The research shows that reaching financial independence isn't about, needing a massive inheritance or being some kind of high-flying entrepreneur. What you need is a shift in perspective, a solid, automated system, and then applying strategic, long-term investing principles directly to that salary you already earn.
So you're leveraging the stability of the paycheck.
Precisely. That stability is an enormous and I think a very underappreciated asset.
Okay, let's unpack this then. We're moving beyond just motivational quotes and into a real structure. We're diving into what the source calls the 4 pillars that you need to transform that predictable monthly paycheck.
The one most people just see as bill money.
Right, from bill money into a powerful, sophisticated wealth-building machine. This deep dive is all about giving you, the listener, a clear, step-by-step blueprint. We're focusing on actions you can actually implement, not just hypotheticals you have to dream up.
That's right. We'll start by confronting the foundational paradox, why most people earn a fortune but keep almost none of it. Then we'll systematically break down those 4 pillars.
Starting with mindset.
Starting with the mindset shift, then moving into the actual mechanics of automation and aggression, then tackling the crucial element of control and discipline, and finally showing how to get to that exponential leverage. It's a complete system designed to move you from feeling financially stuck to achieving, well, mathematical certainty.
Okay, I want to start where the source material does, with a just. A staggering and honestly a pretty uncomfortable statistic that really puts this whole thing into perspective.
I think I know the one you mean.
The analysis points out that the vast majority of Americans will earn well over $1 million, often multiple millions, over their lifetime, just based on, typical salaries, raises, and a standard 40-year career.
That statistic is the critical starting point. It's so important. When you hear the word millionaire, most people, they think of some mythical figure, someone who won the lottery or started Facebook, right?
Yeah, a total anomaly.
They don't realize they themselves will literally earn 7 figures over their working years. But the paradox, the thing that really stops you in your tracks, is that if almost everyone earns this much money, why do so few people actually achieve financial independence or even just retain that wealth?
It's a huge disconnect. It tells me the income stream itself isn't the problem. The 9-to-5 is delivering the capital. So where's the leak?
The problem, and the research really confirms this, isn't that the earnings are insufficient. For most people, the income is more than enough to reach the goal. The problem is a profound lack of what the source calls a financial retention architecture.
A retention architecture, I like that.
Yeah, and a lack of intentional management. Think of it like a dam. Most people have this powerful river that's their salary flowing into a reservoir, but their reservoir is just full of holes. The water flows out as fast as it comes in.
Driven by what? Convenience? Impulse?
All of it. Convenience, impulse, and especially lifestyle creep. The money comes in and immediately it flows right back out. There's just no intentionality.
So from this perspective, the actual size of your salary, as long as it covers your basic needs, is really secondary to how you manage it.
Absolutely.
A $200,000 earner who only saves $5,000 a year could be in a much worse spot than a $60,000 earner who manages to put away $15,000.
That is the key insight. The material points out that the $200K earner often has a higher spending velocity. They feel like they have permission to spend more, which just accelerates the cash flowing out. The 6-figure earner and the mid-5-figure earner, they often face the exact same challenge of retention, just at a different scale.
It's a behavioral problem, not an income problem.
Exactly. If you earn $2 million over your career, but you retire with only, say, $150,000, your focus needs to shift dramatically. You have to stop trying to earn the next $5,000 bonus and start learning how to keep, protect, and multiply the $5,000 you already have.
That reframing it's got to be incredibly validating for anyone listening who is doing well at their job, but still feels like they're just spinning their wheels financially.
It should be.
They don't need a huge career pivot. They just need a radical pivot in their system.
The system is everything. The analysis clearly defines the new mission. Your 9-to-5 job has to stop being seen as just a source of monthly spending money. It has to be recognized as a stable, predictable launchpad for wealth.
Right.
The consistency of a regular job, the predictable timing, the automatic retirement access, the health benefits, all of that is the ideal scaffolding for building wealth. But only if you apply discipline and a system for growth. We're transforming that steady stream of income into a powerful, directed flow toward assets that compound. We're building the retention architecture.
And what's so interesting here is how this flips the script on so much entrepreneurial advice that, romanticizes chaos and risk. This blueprint, it romanticizes stability and predictability.
Which is exactly what a 9-to-5 delivers.
Exactly.
Entrepreneurship requires managing extreme volatility. A 9-to-5. It requires managing your own psychological discipline. And for a lot of people, that path of managing discipline is far less stressful. And when you do it right, it's just as lucrative over the long term. If you don't fix that fundamental lack of intentionality, no amount of income can ever build true wealth because your spending will always, always catch up. The structure has to be sound first.
All right, let's get into the first pillar. This is where we get into the behavioral science of money. Pillar 1 is all about the internal fundamental mindset shift. Money is for multiplying, not for flexing.
This is the most crucial pillar. I really believe that because it governs the success of the other three. If this foundational mindset isn't right, any system you try to build will just crumble under emotional pressure.
What kind of pressure?
Well, the sources dive deep into the emotional trap. We often treat money as a reward for effort. We get a raise or we finish a tough project, we feel good, so we celebrate by upgrading our consumption.
The classic I earned it or I deserve it rationale.
Precisely. I feel good, so I'll treat myself, is the emotional consumption-driven response. The strategic wealth-building response is totally different. It's, I feel good, but how can I make this dollar work for me for the next 10 years without me having to lift a finger?
That shift right there, from immediate reward to deferred growth,
Yeah.
that's everything.
It's the great divide.
That distinction, emotional consumption versus strategic accumulation, it dictates whether the money you just earned goes toward, a depreciating liability that costs you more money later, or a compounding asset that makes you money while you sleep.
And the material drives this point home with a defining quote. It's one that I think really encapsulates the whole principle of this mindset shift. It's essential for listeners to really let this one sink in.
Okay, let's hear it. This is the crucial mindset shift principle, the thing that separates the earners from the wealth builders.
The principle is quoted verbatim. Poor people buy things to look rich. Wealthy people buy assets to become rich. This distinction, it has nothing to do with your income level. It's all about your priority. The financial failure the source talks about happens because money is spent almost immediately on items designed to signal status, the facade of wealth, which generate zero income and usually lose value really, really quickly.
That is just the insidious nature of modern consumer culture, isn't it? It demands that you project success, and in doing that, it forces you to spend the very capital you need to achieve actual success.
You're trapped in a cycle of appearances.
Yeah.
And that quiet, invisible work, the intentional management of money toward assets, that's what leads to real freedom. If your main priority is looking rich, you're always playing catch-up, always leveraging your future capital, which is debt, for these current temporary status objects. But if your priority is becoming rich, you spend money on things that make more money. You create that perpetual motion machine.
I do wonder, though, is there a nuance here we should talk about? For someone early in their career, especially in competitive field, doesn't presenting a certain image, investing in a good suit or a reliable car, doesn't that sometimes act as a strategic asset itself?
That's a great point.
Like, can flexing sometimes be an investment in the launch pad, helping you get promotions and a higher income?
That's a really thoughtful pushback, and the sources would absolutely differentiate between strategic investment and emotional consumption. Strategic spending, things like professional development, getting an apartment that lets you work from home productively, or, yeah, buying the right clothes for a big meeting. That's an investment in your career capital.
So that supports the launchpad.
It supports the launchpad.
Okay.
The problem comes when that spending shifts from utility to pure status. When a reliable car becomes a leased luxury car that costs 10 times as much per month, or a functional apartment becomes some huge place you bought just to show off.
So it's about intention again.
Yeah.
Are you buying the $5,000 suit to look the part and land a $20,000 raise? Or are you buying the $5,000 watch just because you feel like you deserve it and you want other people to see it?
Precisely. The goal isn't to deny yourself every pleasure, but to make sure every dollar is managed with intention. A successful wealth builder, they see their paycheck, and immediately a large, non-negotiable chunk of it is designated as seed money for future growth.
It's off limits.
Completely off limits for consumption. And this is psychologically hard because it requires delaying gratification in a culture that just screams for instant reward.
And what's so fascinating is that this shift, it doesn't require a bigger salary. It requires emotional intelligence applied to your own personal finance. The disciplined earner understands that a dollar sitting in a checking account, or worse, spent on a new TV, is a dollar that isn't working. Every single dollar needs a job, and the highest priority job has to be multiplication.
If you leave this section with just one thought, it should be this. You have to prioritize the eventual reality of financial freedom over the immediate appearance of success. The millionaire, built on a 9-to-5, they often look completely ordinary because their money is working in invisible assets. Index funds, real estate, retirement accounts, not parked in their driveway.
Okay, so if pillar one was the philosophical shift, pillar two is the mechanical requirement that makes the whole system run without fail. Automate and increase your investing. We're moving from belief to enforced, disciplined action.
This is where we make the discipline from pillar one unavoidable. The material recognizes a fundamental flaw in our behavior. We're all prone to decision fatigue, to procrastination, and to self-sabotage when we see a big cash balance in our account.
It's just too tempting.
It is, and that's why the source material has this critical mandate. If your investing is not automated, it won't be consistent. And inconsistency is the absolute enemy of compounding wealth.
Okay, let's really break down the power of automation. Why is it so crucial? Is it just because it physically removes the choice?
That's a huge part of it.
Like, if I have to manually transfer a big sum of money on the 15th of the month, I might feel tired, or I might see a new gadget I want, or decide I need a vacation. But if it's automated, it's gone from my account before I ever even consciously see that money.
It eliminates the emotional negotiation completely. When your paycheck hits, the money is already allocated to its highest purpose multiplication before it ever becomes available for you to spend. This enforces long-term habits no matter what the market is doing, what your mood is, or what unexpected expenses pop up. It makes the strategic decision effortless and the emotional choice impossible.
The ultimate set-it-and-forget-it strategy.
For a busy professional, absolutely.
So if we're committed to automation, which seems non-negotiable, where exactly does the material say we should be putting this money? We need a clear, actionable list for anyone listening.
The list focuses on proven, efficient, and often tax-advantaged vehicles. First and foremost, you maximize your company plans, your 401k, 403b, or the TSP if you're a federal employee. The number one priority is always to get the full company match.
Because that's an immediate guaranteed return.
It's free money. It reinforces that multiplier mindset from day one.
Okay, free money, always. What about after you've secured the match?
Next, you prioritize funding a Roth IRA. The source material loves these because they allow for tax-free growth and tax-free withdrawals in retirement. For anyone young or mid-career who expects to be in a higher tax bracket later on, that flexibility is just immensely valuable.
And then?
And finally, for simplicity and broad market exposure, the material is a huge advocate for passive index funds, specifically ones that track the S&P 500 or the total stock market.
That index fund approach, that seems perfectly aligned with the whole philosophy of using your 9-to-5 as a stable launchpad.
It is.
It removes the need to be some kind of market genius or a high-risk trader. You're just betting on the entire engine of the economy, not trying to find one specific winning stock.
Exactly. You leverage broad market returns, which have been historically strong for decades, without the high fees or the stress or the research time that comes with active management. This whole blueprint is designed for the high-performing employee whose energy needs to stay focused on their career on the launch and not be spent day trading.
Okay, now here's the crucial challenge the material brings up. It's about contribution levels. A lot of people feel pretty responsible contributing, 2% or 4%, usually just enough to get the company match. What does the blueprint say about those numbers?
The analysis is it's unflinching on this point. Investing 2 to 4% is not enough.
Not enough.
Mathematically, that percentage just isn't sufficient to overcome inflation and generate rapid wealth accumulation inside a typical 30-year working window. It creates the illusion of effort. It feels good psychologically, but it just lacks the quantitative punch to get you to the goal in a reasonable amount of time.
So what does the blueprint demand? What's the necessary input to actually power this engine?
The recommended minimum is aggressive, and it's designed to front-load the compound interest effect. You have to start at a 10% minimum of your paycheck. But the real accelerator, the sweet spot that makes the 9 to 5 a genuine path to 7 figures in a sustainable time frame, is 15 to 25% of your gross income.
Okay, that 15 to 25% figure is where I think a lot of listeners are going to balk. That sounds incredibly difficult, especially for people in high cost of living areas where, rent and basics can eat up 40 or 50% of your check right away.
That's a critical challenge, and the blueprint addresses it by making a distinction between necessity and optionality. In a high-cost area, hitting 25% often requires painful choices, especially around housing and transportation, the two biggest spending categories.
So what's the argument?
The source material argues that if hitting that 15 to 25% threshold seems impossible, it means one of two things. Either you're dealing with non-wealth building debt that has to be eliminated first, or you're consuming way too much in non-essential categories like dining out, entertainment, luxury subscriptions, the death by 1,000 cuts.
So for the person in a high-cost city, that 25% target is the signal that you have to be absolutely ruthless in every other area of your life. You sacrifice the status objects and the convenience until you hit that investment rate.
Exactly. The sacrifice is the price of admission to what they call the 15-year wealth track. And that brings us to the key aha moment, the math that shows what a difference this aggression makes.
Lay it on us.
The mathematical difference between consistently investing 3% versus 25% of your income could mean reaching millionaire status in, get this, 60 years versus 15 years.
60 years versus 50. That's not a small difference. That is the difference between being financially free in your mid-40s with your money working for you during your best years and having to work until you're 90 years old to catch up.
It's everything.
Can you break down the math on that? Why is the difference so huge? Why does adding that extra 22% cut the time by 3/4?
It's the interaction of two exponential forces, which is why time is your greatest weapon. Let's just imagine two investors, right? Both earn a solid $70,000 a year. They start at age 25, and they get an 8% average annual return. Investor A contributes 5%. That's $3,500 a year. Investor B contributes 25%. That's $17,500 a year.
Big difference right from the start.
Huge. After 10 years, Investor A has put in $35,000, and their account is maybe worth around $55,000. Investor B has put in $175,000, and their account is already nearing $260,000.
Okay, so a massive gap already, just because B is putting in so much more capital.
But here's the critical point. The compounding begins on the entire balance. So for Investor B, the returns in year 11 are generating wealth on $260,000. For Investor A, they're generating returns on just $55,000. The extra money Investor B put in early is worth exponentially more than the money A puts in later because B's money has 10 more years to compound on itself.
The time saved is directly proportional to the capital you supply at the beginning.
It completely relies on front-loading the system. The 3% investor is relying almost entirely on the market to do the heavy lifting, which takes 6 decades. The 25% investor is relying on massive, consistent contributions plus market returns, and that's what cuts the timeline down to a period where freedom is actually relevant.
So if you wait until you get that big raise at age 45 to start putting in 25%, you've already lost decades of compounded growth that you can never, ever get back. You have to be aggressive now.
Absolutely. And the source material has a great little test for people who think 15 to 25% is impossible. It's called the experiment.
Where's that?
They suggest you try increasing your contribution to 20% for just 2 weeks. The goal isn't to commit forever. It's to force yourself to see what the lifestyle adjustment actually feels like. And most people, they find they adjust to the smaller take-home pay way faster than they expected. They realize the money they were spending before wasn't really tied to their actual quality of life.
It proves the constraint is psychological and habitual, not a real financial necessity. I love that. Friction testing your own budget. It shows you don't need some massive, painful overhaul. You just need to challenge your own comfort zone. So pillar 2 is the engine. Enforced consistency through automation, and then quantitative power through aggressive contribution rates.
If you take one piece of immediate, actionable advice from this whole deep dive, it should be this. Log into your retirement portal and increase that contribution percentage. Move yourself from the 60-year timeline onto the 15-year timeline.
Okay, pillar 3. This shifts the focus from the automatic flow of money into investing and onto the daily conscious management of what's left. This is take control of your money, emphasizing discipline over dollars.
This section brings us right back to that initial paradox we talked about. It's all summarized by the core premise. What you keep matters more than what you make. We're building wealth with a 9-to-5, so we have to accept that true worth comes from discipline and retention, not just from the size of the income.
We established that a high salary gives you high potential, but it's no guarantee of wealth. The sources even give examples of high earners who are drowning in debt.
Oh, yeah. The material points out that people earning $200,000, even $300,000 a year, can still be drowning in debt if they don't have spending control. A high income just gives you more rope to hang yourself with, financially speaking.
Right.
If you earn $300,000, but your expenses are $310,000, your wealth trajectory is worse than someone earning $60,000 and living on $50,000. Discipline, that intentional management of your cash flow, is the real engine of accumulation.
And the most pervasive threat to that control, especially as you get raises and promotions, is lifestyle creep.
Lifestyle creep is the silent killer of middle-class wealth. It's that phenomenon where your income goes up, but your expenses inflate at the exact same rate, basically neutralizing the financial benefit of the raise.
You're just broke at a higher level.
Broke at a higher level, exactly.
Right.
People get a 10% raise, and immediately they upgrade their car payment, they move to a higher tier of dining out, they buy subscriptions they don't need, or they decide they have to have a bigger house. Suddenly, even though they're earning more, their savings rate is the same, or sometimes even lower.
It's that death by 1,000 cuts, again, where all the convenience spending just erodes that disciplined savings rate.
Yeah.
Premium food delivery every night, a subscription for everything.
Exactly. Those modern conveniences are incredibly sticky and habit-forming. They feel like small expenses on their own, a $15 delivery fee here, a $20 streaming service there, but when you add them all up, they can easily eat an extra $500 or $1,000 of monthly income that should have been going toward that 25% investing target.
So how do you fight that? The strategic response to a raise has to be, what, codified?
It has to be a hard and fast rule. The rule is very precise, and it's mandatory for a wealth builder using this 9-to-5 strategy. You should only allow yourself to spend 5 to 10% of any raise or bonus. The other 90 to 95% must be automatically invested, usually just by upping the percentage we talked about in Pillar 2.
That is psychologically brilliant.
Yeah.
You still get to acknowledge the feeling of earning more. You get a little win, a small upgrade, but you make sure the bulk of that new income immediately speeds up your timeline to financial independence.
It turns your annual review into an automatic wealth acceleration event.
Instead of a trap.
Right. Instead of the typical trap where a raise means you upgrade your life to the point of being broke again, this blueprint forces you to systematically use every single income increase to increase your assets. If you get a $10,000 annual raise, that's about $833 a month. You might let yourself spend an extra $50 or $80 a month, maybe upgrade one service, but the other $750 goes straight to your 401k percentage.
We've talked about the systemic control, but what about the immediate temptation, the impulse purchase that can derail a whole disciplined month? Are there tools for that moment?
Yes, and the sources introduce a crucial tool for impulse control by introducing friction. It's called the 5-day delay rule.
The 5-day delay, how does that work?
For any non-essential purchase over a certain amount, say $100 or $200 if you see something you want, a new gadget, an expensive coat, a flight booking, you have to enforce a 5 full-day waiting period before you can buy it.
And that delay, it works because it lets the initial emotional high, the dopamine hit of the impulse, just wear off.
Right.
It forces the rational brain to take over.
Exactly. Impulse buys are driven by the limbic system, that part of your brain seeking immediate gratification. 5 days is enough of a cooling off period to allow for a rational assessment. You have time to check your budget, research the item, and most importantly, reconnect with your long-term goal of hitting that 15-year timeline.
I could see that working.
I remember last year I almost bought one of those fancy espresso machines. It was like $1,500. By day 4, I realized I wanted the idea of being the person who makes perfect espresso, not the actual machine or the maintenance or the counter space it would take up. That money went into my Roth IRA instead.
Such a relatable example. The 5-day delay helps you separate a genuine need or a strategic investment from just temporary status fulfillment. It's all about building these practical barriers between your cash and your desires.
And that need for limits is summarized perfectly in the final quote for this section. Your lifestyle will eat your wealth if you don't apply limits. This applies to both the big impulse buy and the slow, steady erosion of lifestyle creep. If you don't apply these rigid boundaries, our natural human tendency toward comfort will just. It will inevitably consume your ability to save and invest no matter what your income is. The discipline is the armor that protects the wealth you've earned.
Okay, we've got the right mindset, we've automated our aggressive contributions, and we've gained control over our cash flow. Now we get to the final and most exciting pillar. Pillar 4. Let your money make more money. This is where you transition from working for your money to having your money work for you.
This is where all that long-term discipline finally translates into exponential growth. The core engine that the source material identifies is compound interest, which they rightly call the silent wealth builder. It's silent because the growth isn't loud or flashy day to day, but its power over decades is the key thing that separates ordinary savings from extraordinary wealth.
Compound interest. That magic of earning returns on your returns. The financial snowball that accelerates as it rolls downhill.
Right. But that snowball, it needs fuel, which is your capital, and it needs momentum, which is time and investment. And that leads us directly to the absolute necessity of investing. You can't achieve this kind of multiplication just by saving cash.
You mean just leaving it in a savings account?
Exactly. The source emphasizes the danger of holding cash by pointing at the constant threat of inflation. If inflation is averaging, say, 3% a year and your savings account is giving you 0.5%, your money is actively losing 2.5% of its purchasing power every single year.
So money can't just be stored.
It can't be stored. It must be invested into assets that are designed to outpace inflation and allow for compounding. Investment is not optional for a wealth builder. It is mandatory.
Okay, so we're investing money into assets that facilitate this compounding growth. We're leveraging the investment menu, specifically assets that work well with the consistent capital flow from a 9-to-5 earner. What's on the menu?
The menu is pretty robust. They suggest leveraging assets like real estate, even just starting with one rental property. And what's crucial here is recognizing how your 9-to-5 makes this possible. The steady, verifiable income from a regular job is exactly what makes you highly creditworthy.
So banks love you.
Banks love lending money, mortgages, to stable 9-to-5 employees. That allows you to use leverage, borrowed money, to acquire a massive asset. This is a form of leverage that a volatile, self-employed person often struggles to get.
It's a huge point. Your stable income is the currency you use to get cheap debt, which, when you use it to buy an appreciating asset like property, just turbocharges your wealth creation.
Absolutely. The stability of the launchpad lets you access the power of debt. And the goal is to turn the money from your job into assets that generate their own cash flow.
What about the truly passive approach, though, for people who don't want the headache of being a landlord?
That's where index fund growth really shines. Consistent automated contributions into broad market funds like the S&P 500 or a total stock market fund. That ensures reliable capital appreciation over time. And for a third category, they recommend dividend-yielding investments.
How do those work to accelerate things?
Well, they provide immediate cash returns that you can then automatically reinvest through something called a DRP, a dividend reinvestment plan. This just accelerates the compounding loop. It links perfectly back to the automation mandate in Pillar 2. The dividends you get are automatically put back to work, buying more shares, which makes the asset base grow without any extra effort from you.
All these investments, they share a common philosophy. They're designed to be passive. This lets the earner keep their focus and high performance on their 9-to-5 career, the capital source, while their money is just working furiously for them in the background.
The 9-to-5 stays as the powerful source of capital, but once that capital goes into these assets, it gains leverage and starts generating its own income stream. You are effectively hiring your money to work for you 24/7, and that vastly outpaces the returns you could ever generate just by trading your time for a paycheck.
To quantify this leverage, the source material provides some historical validation, right? It puts a specific number on the market's power that you can reliably plan around.
Yes. The key historical fact is that the U.S. stock market has, over the long term, returned approximately 9% annually. And while we always have to say that past performance isn't a guarantee of future results, that multi-decade average gives us a realistic baseline for our projections. It's the engine speed we can expect over a 15 or 20-year period of consistent investing.
So let's translate that 9% return into a concrete number.
Yeah.
Show us the exponential power of time and consistency, that mathematical certainty we talked about at the beginning.
Okay, consider $1 you invest now. If that dollar is invested wisely and it leverages that 9% historical return, in 10 years it becomes $2.36. That means your original dollar earned $1.36 for you, purely through compounding. Now, scale that up. Imagine your entire $50,000 contribution base over 5 years, compounding not just at 9%, but at 9% on top of the principal plus the previous year's earnings. That is how steady accumulation combined with the patient application of time generates fortunes from ordinary salaries. It's the systematic commitment to that 15 to 25% investment rate sustained until the exponential growth phase of compounding just takes over.
And crucially, that power of multiplication is only possible because Pillar 1 gave you the discipline to save, Pillar 2 gave you the automation to be consistent, and Pillar 3 gave you the control to protect the capital from lifestyle creep. It's a closed-loop system.
The entire blueprint only works because the 4 pillars are interdependent. You can't skip the mindset shift and expect the automation to stick. And you can't get massive leverage if your contribution rate is stuck down at 3%. Every single step supports the next. Hashtag outro.
This has been an incredibly rigorous and deep dive into the strategic blueprint for leveraging a stable 9-to-5 job into genuine millionaire status. Let's just quickly synthesize the 4 pillars of this journey one last time.
Let's do it.
We started with a foundational mindset. That was Pillar 1. Money is for multiplying, not for flexing. Then we enforced the mechanics of consistency by demanding aggressive automation and increase. That was Pillar 2, targeting that critical 15 to 25% contribution rate.
Then we protected that capital through necessary control and discipline, which is Pillar 3, defeating lifestyle creep and using the 5-day delay.
And finally, we enabled the exponential growth engine of leverage. Pillar 4, letting your money work for you through compounding assets like index funds and real estate.
The overarching takeaway from the whole analysis is, I think, a really powerful and reassuring message. Financial independence doesn't rely on luck or volatility. Ordinary people can become millionaires through patience and consistency. The system works because it relies on behavioral discipline and mathematical certainty. It's the unsexy path to wealth, but it's reliable, it's predictable, and it's fully within the control of anyone who earns a consistent salary.
For those of you listening who are ready to apply this blueprint and start accelerating that timeline, the authors of the source material provided some specific resources and tools to help you translate these ideas into immediate action.
Yeah. For a comprehensive system that really reinforces these steps, the authors recommend the book Manage Your Way to Millions by Smart Money Bro. And, more importantly, for practical application, they offer a full system online at smartmoneybro.com. That resource has all the necessary templates, worksheets, budget trackers, and a full breakdown of the 4-step system we've discussed, which lets you move beyond theory and start implementing your own wealth retention architecture right away.
That immediate application is the most vital step. And as we close out this deep dive, I want to leave you with one final, provocative thought that builds on the most important quantitative insight we discussed today. We highlighted that staggering difference in timelines. 60 years versus 15 years to become a millionaire, based purely on whether you commit 3% or 25% of your income. So forget your current salary for a moment and focus only on the discipline of your saving. Based on your current investment percentage, right now, which of those 2 time frames are you tracking toward? Use that specific measurable answer as the absolute catalyst for the change you need to make today.
Welcome to The Debate. Today we are examining a truly bold claim laid out in recent source material. The idea that achieving millionaire status isn't just for entrepreneurs or high flyers, but is entirely accessible to the ordinary person using only a standard 9-to-5 job.
Right. And this material presents a 4-pillar strategic system: mindset, automation, discipline, and leveraging as a kind of guaranteed pathway. So the central question we really have to grapple with is one of, Well, sufficiency and universality. Is disciplined adherence to these 4 internal behavioral pillars genuinely enough for any ordinary person to reach financial freedom? Or does the plan fundamentally overstate the power of personal control relative to, external economic prerequisites?
I'll be focusing on those internal levers. My position is that the system is structurally sound and, frankly, predictably effective. I'm arguing that the primary block to wealth is behavioral failure, and this blueprint provides the necessary tools to overcome that failure, regardless of the starting salary, provided it's consistent.
And I'll be focusing on the stringent, non-negotiable quantitative demands of the plan. I'm going to argue that the implicit income floor and the unavoidable reliance on specific external market conditions really challenge the plan's universal applicability, particularly for median earners who are struggling with high mandatory living costs.
The material's core message is revolutionary because it reframes the fundamental problem. The obstacle isn't income size, it's retention. The source material highlights that a vast majority of Americans will earn upwards of $1 million over their working lives, yet most fail to retain or multiply any of that capital. They spend emotionally rather than strategically.
I agree that emotional spending is a disaster for financial health, but I see the problem as more systemic than just a series of poor choices.
Well, that's precisely where the mindset shift pillar comes in. It's the critical first step. It dictates that money is not for immediate consumption or flexing, but for multiplication. The principle is concise. Poor people buy things to look rich, wealthy people buy assets to become rich. This shift provides the philosophical guardrail that prevents debt accumulation, a failure that, as the material notes, even high earners making $200,000 or $300,000 fall prey to without this disciplined framework. The failure is internal, so the solution must also be internal.
They'll concede that without discipline, no wealth plan works. That's obvious. But the success of this blueprint really hinges on the automation and leveraging pillars, which require a massive capital input. I just come at it from a different way. While the principles are crucial, the entire architecture relies on one quantitative factor that is far more challenging than simply avoiding a new car: an aggressive mandatory investment rate, a minimum of 10%, but ideally 15 to 25% of one's paycheck consistently invested into assets like 401ks and index funds.
And this high rate is key to leveraging compound interest, which is the engine that converts that regular 9-to-5 paycheck into 7 figures.
Exactly. But this high savings rate implicitly contradicts the premise of ordinary. If we define ordinary as, say, a median earner, a person earning $60,000 in a major metropolitan area, the plan stresses what you keep matters more than what you make. But that metric becomes functionally unattainable for many because they lack the necessary income floor to maintain basic life and hit that 15 to 25% contribution rate. And then the material suggests extreme discipline, like immediately investing 90 or 95% of any raise or bonus. I mean, that level of internal control is required to compensate for a simple external prerequisite that is missing for many: sufficient net disposable income after mandatory living costs. I'm sorry, but I just don't buy the universal application because that required investment percentage is an immediate, severe barrier for the truly financially constrained.
Okay, let's delve into that feasibility question, the 15-25% rule, because I think the material provides the toolkit to solve it. It frames it as a measure of behavioral control rather than income constraint. The core assertion is that the funds required to reach that level are often hidden within discretionary spending money that is just leaked, rather than strategically allocated.
And how does the blueprint propose they find that money?
It operationalizes the mindset shift. For example, the material outlines the 5-day delay rule for curbing impulse spending. It forces a cooling-off period before any non-essential purchase. It also proposes the experiment, challenging the reader to try 20% contribution for just 2 pay periods to demonstrate that, a budget adjustment is possible. The math here is relentless. The difference between investing 3% and achieving wealth in 60 years versus 25% and achieving it in 15 years proves that individual choice and consistency dictate the timeline and success. The power lies in realizing that time is the only non-renewable asset being leveraged here.
I respect that critique of discretionary spending, but let's look closer at the mathematics of necessity. That's a compelling argument, but have you considered that for individuals facing genuinely high mandatory living expenses, like people in high cost of living areas where rent might eat up 40% of their take-home pay, or people managing significant student loan debt, or single parents dealing with essential childcare cost, the required funds for that 15 to 25% threshold may simply not exist in impulse buys or luxury coffee runs?
But the plan is designed to make one look at every expense as discretionary. If the goal is financial freedom in 15 years, the material argues that things like expensive housing or non-essential subscription services become discretionary failures.
That assumes everyone has a viable alternative. Let's use a specific, relatable scenario. Imagine a certified medical assistant, or Jane the paralegal we talked about, making $65,000 a year in a major city post-2020. Her mandatory rent, utilities, and transportation might consume 55% of her net income, leaving very little margin. Lifestyle creep is a problem, yes, but avoiding lifestyle creep is fundamentally different from having no margin left after covering essential, mandatory expenditures required just to participate in the workforce. For that person, a mandatory 25% contribution rate means sacrificing basic necessities, not just giving up an impulse purchase. The plan's success is limited to ordinary people who are already higher earners relative to their geography, or, those who have unrealistically low fixed costs.
I see why you think that, and it does highlight the stringency required. But let me give you a different perspective, focusing on the second half of the equation, the leveraging pillar. The source emphasizes that the individual has to make the transition from working for money to letting money work for you. This is the engine of the plan. It requires feeding the system consistently and automatically into assets like index funds. And the historical fact that the U.S. stock market has consistently returned an average of approximately 9% annually over the long run provides the robust external growth mechanism. The individual's job, mandated by the discipline pillar, is simply to feed the system consistently for 15 years. Any volatility you might cite in external markets is mitigated by the consistency and sheer longevity enforced by the four pillars. Internal control shields the investment from short-term fear, which guarantees long-term exposure to that powerful historical average.
That's an interesting point, though I would frame it differently. You claim the system is predictably effective because the individual controls their behavior, but the success of the letting money work for you pillar is entirely dependent on the continuation of that sustained external performance, that 9% historical return. If someone commits 25% of their income for 15 or 20 years, their eventual seven-figure outcome is completely reliant on that external growth rate holding true.
And why wouldn't it? That average reflects decades of economic cycles. It is robust.
Because averages can be misleading, especially over a specific 15 or 20-year accumulation period. I mean, if market conditions were to fundamentally change, if we entered a period of sustained, long-term economic slowdown, or if high inflation eroded returns, that strategic blueprint fails to deliver seven figures despite the individual maintaining perfect, unwavering 25% discipline. The reliance on that external economic engine makes the plan less of a guaranteed outcome of internal discipline and more of a massive, leveraged bet on the continued, robust health of the U.S. equity market.
But the volatility inherent in the market is precisely why the discipline pillar exists. If you panic sell during a downturn, you lock in losses. If you maintain automation and continue feeding that 25% into the market as the pillars demand, you are simply buying assets on the cheap, accelerating your wealth accumulation when the market inevitably recovers. The volatility is managed by internal composure.
But you are focusing on managing volatility. I'm focusing on structural risk. The sequence of returns risk is real. If our hypothetical 35-year-old disciplined investor begins their plan and then faces a sustained, decade-long bear market, say the 9% average drops to 4 or 5% for the critical first 10 years of accumulation, their ability to hit millionaire status by 50 is severely compromised, even if the market later recovers. Their flawless behavior doesn't change the underlying physics of capital growth. The external environment determines the outcome, not just their internal effort.
I'm not convinced by that line of reasoning because while asset growth is the necessary fuel, it minimizes the foundational element of the system. True wealth building, as laid out in the material, focuses on the behavioral core. Your lifestyle will eat your wealth if you don't apply limits. The discipline pillar, avoiding lifestyle creep, and the mindset pillar are the actual foundational elements that differentiate the accumulator from the spender. The material teaches readers to manage their income with fierce intention.
But we're arguing about what truly creates the seven-figure outcome. You argue that the discipline required to fund that 15 to 25% rate is the essential ingredient. I argue that discipline is necessary, yes, but it is merely the delivery mechanism. The true creation mechanism is asset growth.
Yes, but the act of saving 25% is where the power lies. It's the intentional choice to convert the maximum possible amount of finite labor, that regular 9-to-5 paycheck, into infinite, compoundable capital. That is the leverage.
And I agree that discipline is vital for capital retention and consistency, but the material itself explicitly notes that inflation devalues cash. So money needs to be invested in growth assets, not merely stored. The outcome of achieving seven figures is functionally determined by the success of the asset acquisition, be it index fund appreciation or real estate growth. Discipline alone, absent robust external growth, only leads to financial stability and a very large inflation-eroded cash buffer. The fundamental mechanism for achieving the millionaire promise is compound interest, which requires the assets to make substantially more money than the individual puts in. Without adequate sustained capital growth from those external assets, internal discipline only results in stability, not millionaire status.
But the entire point of this system is to ensure the capital is available to capture that historical growth, which is, historically inevitable over sufficient time spans. If you don't commit the 25% consistently, you miss out on the greatest periods of growth. The power is in maximizing the exposure to the external engine, and only internal discipline ensures maximum exposure.
And my point is that the system implicitly defines ordinary as someone who already possesses the financial margin to easily sustain that maximum exposure, thus limiting the plan's applicability to a privileged subset of the population. For the truly median earner, maximizing exposure requires choices, like Jane the paralegal choosing between living near work or cutting her food budget, that fundamentally negate the claim of easy accessibility for any ordinary person.
The blueprint challenges the very notion of necessity itself. It reframes ordinary life choices as strategic wealth decisions.
And in doing so, it places an unreasonable burden on the individual to compensate for structural economic realities that they cannot control, such as high healthcare costs or unavoidable housing inflation in major economic hubs.
The strategic blueprint offers a clear, achievable, and frankly, an accelerated path for a wide swath of the population who currently suffer from behavioral leakage. My perspective remains that ordinary people can become millionaires if they commit to the system, shifting their mindset, automating that high 15 to 25% investment rate, and applying rigorous discipline to curb lifestyle inflation and emotional spending. The control over the crucial factor, the contribution rate and longevity, is internal, and the results are defined by long-term adherence to those four pillars.
And while the pillars provide excellent guidance for financial health and behavior modification that everyone should adopt, and they are powerful tools for optimizing an already healthy income, the plan's claim of sufficiency for all ordinary people is fundamentally questionable. The high savings requirement places an implicit, unavoidable income floor on participation, and the ultimate achievement of millionaire status hinges too heavily on favorable external market conditions, especially the continuation of robust historical returns over the accumulation period, rather than purely internal behavioral changes.
Examining these different perspectives certainly illuminates the necessity of intentional financial management and consistency. The blueprint effectively maps out the internal control required to maximize one's potential for wealth accumulation.
Indeed, and it also highlights the limitations of internal effort. Achieving long-term financial freedom requires both profound personal discipline and a realistic understanding of the necessary economic systems and income prerequisites required for true wealth multiplication. There is clearly more to explore in how these internal systems interact with and are sometimes constrained by external realities.